righty. This is Roy Strong, and we're going to get started now. It's a couple minutes after 1, so we will get started. We miss seeing you. We not only miss seeing you today on the screen, but in general with the COVID-19 situation going on. But we wanted to take this as an opportunity to kind of do a halftime report. Now, it's interesting when we do halftime reports normally, it's interesting, but this year is totally different. And so we want to take a look at this year and where we are, where we've been, and where we think we might be headed to. So I just want to welcome everyone. Most of you know that we primarily deal with helping people set primary goals. Everybody's different though. Even though many times you think you're alike, you're different. We're going to talk about the U.S. markets. We're going to talk about what the fundamentals that's supporting the economy looks like, and then market forces. If you have any questions, you can type them in the chat box. Stephanie and Sarah are here helping me. Stephanie's in here with me, so we can type it in the chat box, and then we can see your questions. One of the goals today is to try to determine what in the world to do under the current market conditions. It's going to be impossible to cover everything. We don't even know the questions to ask in many cases. We're finding out new things all the time. But we will review some of the key economic fundamentals and what lies ahead in the second half. I'm assuming everybody can hear me okay. If not, you need to type in the chat box that you cannot. Let's start reviewing the U.S. market, see where we are. This is an interesting looking chart. That chart looks in a scary way, it looks like 2008. If you think back to 2008, what happened? We saw 2000, 2001, 2002 to be horrendous years, and then we had a nice little increase up until 2007, late 7 and 08, and the market dropped like a rock. And that's what we've experienced here. So if you take a look at it, in January the 15th, and we hit actually it turned out to be February the 20th is when the market really started to drop. Now, this is the S&P 500. The S&P 500 tracks the largest 500 stocks and has an index. And the index is stagnant. It's not managed. It's not traded. Every once in a while, they'll change one of the stocks that's in there. But this is a snapshot, day-to-day snapshot for this year. Now, we take a look, the S&P 500 ending in 2019 was at 3231. This chart shows what some of the guesses of what the S&P 500 would be by Morgan Stanley and UBS and so forth. Now, the high point this year has been 3231. We have a technicality here. Just go back.
Yeah, let's start with the thing.
No, can you just pick up where we left off? Yeah. Okay, so Morgan Stanley thought that at this point in the year, we'd be at 3,000. And UBS 3,000. You can see how they go down through there. And Goldman Sachs says 3,400. So did BMO. We are basically right at 3,000, 3,075 at the end of June. Some of the key milestones that we want to look at really part of it has to do with volatility. It's what's called a VIX index, VIX. And the VIX index is like the highest it's ever been. And it's an indicator of the volatility of the market. So one day you look at the market, the S&P 500, and it's up 300 points. Now this is happening the same day. You look a little later, a little earlier, you know, it's down 100 points. When the VIX is high, the volatility is great. Okay. What drove the U.S. equity market performance? If we take a look at what's happened, this is a chart of last year's. This is 2019, or excuse me, 10 years ago, 2010 of January. The green indicator is what we would think it would be. These are indicating strong markets, positive. The yellow indicates neutral, and we don't have any red on this one, but the red indicates negative. So it gives you an overall picture of what's happening in the market. It's also taking a look at the U.S. economic outlook, taking a look at corporate profits, monetary policies, labor markets, and so forth. And when those are green, it's a good indication that for the next 3 to 6 months, that we could expect a strong upward market. Now, that's January of 2010. Okay, the next slide is January of 2020. So even before the real COVID situation hit, we saw monetary policies not quite as green as they were. The U.S. economic outlook had already gone to neutral. And so when we take a look at this, we see about an even division between the green and the neutral, and we already picked up a couple of red. I think it might be important to look at what the red ones are. Political environment and geopolitical risk. We're already turning red. Okay, let's go to the next one. Now, this is June 2020. Now we've got 5 reds instead of 2. Now we have more yellow. Oh, no, excuse me. Let's see, 5, 6. We got 7. We got 7 reds instead of 2, and we have about an even division with yellow and green, with yellow being a little more predominant. All these indicators are showing a shift. Now you say, well, yeah, in June, you know, that's a no-brainer. I mean, we're in the middle of a pandemic, and everything was coming apart. That's true, but people were still making money. And we'll talk about that more. The COVID-19, the pandemic there, we saw historic federal intervention and fiscal stimulation, economic measures on reopening. We saw things we'd never even thought about. And we saw China, we saw the world on the same page. You know, we saw countries shut down. You know, March 15th, we saw here in the United States, the Fed's cut rates to 0. I never remember it being 0, and best of my knowledge never has been. The on March, that's March 15th, again on the 15th, the Federal Reserve bought over $700 billion in assets. Now, I'm not going to get bogged down in the weeds on this, but they're from this March the 15th all the way through June the 8th. One of the focuses of the Federal Reserve is trying to keep various aspects of our economy liquid. Now, I can give you an example that may not be parallel, but if you've gone to the store, you might see a sign that says, we need exact change. Or if you don't have it, they won't give you any change back. That's just a little indicator of liquidity. Now, I don't know what kind of correlation we can really draw because not much is being admitted right at this point, but somehow it's all interconnected. We take a look here at inflation trends. Now, we've been groomed or trained to be concerned about inflation. If we take a look back in the 70s, we saw inflation like 15%. And then since 85, it's come down. Right now, we're looking at inflation very close to well, let's say under 2%. This is an interesting chart on the labor market. The blue lines are wage growth. So it's up, it's down. But look at that, especially in the more recent years. Look at the black line, which is unemployment rate. As we see, like June 1992, unemployment was 7.8%. Look what happened to wage growth. It dropped. Let's go on out here currently all the way to the far right. When we take a look at wage growth, it's up 7.5%, but our unemployment at that time, that was April, was down 14.7%. Really messes with your charts to start with, but we since the Great Depression, we haven't seen the unemployment down 14.7%. The good thing that they touted is that we were seeing gains in wages. This is a consumer sentiment, and consumer sentiment is so very important. The University of Michigan has a consumer group that tests. They do a survey, 500 people a month. That's what those little black dots represent. Those are monthly. And what then the blue is the 3-month moving average. But out here in 2020, right now, the sentiment is up. So when we see those little black dots, they've turned around and they've gone up. So we're seeing consumer sentiment improving, increasing. That's important. It's frustrating for some. Jim Cramer is one. I got a little email, and he was complaining because I don't know if he used the word idiots, but that's what he represented. The people investing keep driving the prices of the stocks up, even though we're having some pretty negative news. So consumer sentiment is running positive. Now, I'm not sure how you differentiate this, but October 12th of 2018, so almost getting close to 2 years ago, set over 75% of all stock market trades were done by artificial intelligence, by program trading. And I think it was on the October the 12th, it dropped 400, 600 points based upon some news that the Federal Reserve was raising interest rates. That was the news for the day. And we've seen since then that the market, that I believe this is contributing to the volatility in the market, is going up and down based upon, we can look at it as an element or a portion of consumer sentiment, but really it's almost like things are being artificially modified, manipulated. Now, I had some disclaimers at the beginning of this. I put a big disclaimer over the whole thing is a lot of this is my opinion. So as long as we keep it in that frame, we're okay. So when we take a look at that, we're seeing an underlying pressure to get things back in order. Okay. If you take a look at this, another thing you hear about quite often is the number of real estate starts, you know, what's happening with the stock or with the housing market. From February to March, there was a window there that the number of homes being sold peaked, and for a month there, it really maxed out, and we can see since then what's happened to residential sales. I know a person that sold a house right at the tail end of that. It was a great time. Household debt, it's down to 9.7%. That's as of the first quarter of 2020. So hopefully we're getting things somewhat in order. Represents the news. News drives the sentiment as well. We have COVID-19 treatment. Some days when you look and see what's driving the market up, it's like the middle newspaper there. COVID-19 vaccine advances or treatments approved. The Americans elect a president. You know, that's like a roller coaster right now. It's up, it's down. When we take a look at the market forces, if we look at where the blue line stops, that's 2019. So that's at the end of 2019. I remember it was, I believe, March of this year, 2020, that they were trying to guess what the second quarter was going to look like from a GDP standpoint. That's what this chart is, a GDP. And some folks had said, well, it's going to be off, you know, 10, 15%, and so forth. Then they started coming out with some information that said, no, it's going to be off 20%. No, it's going to be off 25%. And ultimately what I heard was it's going to be off about 32% from the second quarter. And that was pretty close to what the second quarter GDP was down. Now it's looking at, you know, gaining some towards the end of the year here, and suggesting that in 2021 we will see a pretty good year. 2022 not quite as good, and 2023 a reduction. Some folks have already suggested that we're going to see some serious changes in our market and our economy in 2023 for a number of reasons. The feds are the ones that have these open market meetings and make decisions whether they're going to raise the interest rates or lower the interest rates. And these are the dates of those meetings. And they have a 2-day meeting, and then you'll hear that they're lowering or keeping it the same or raising it. The head of the feds, Mr. Powell, has indicated that he does not want to have a negative interest rate in the United States. So we're at 0, and so he's trying to hold the line there, so it doesn't go down anymore. But they're in charge of making a lot of decisions and keeping the country moving and productive. When you talk about fundamentals, when we take a look at bonds, a lot of times people say, well, I'm 60% equities, 40% bonds. And during the tough times, the more volatile times, they'll switch that. I'm 40% equities, 60% bonds. If you go back and take a look at 2008, for instance, people were trying to diversify. They felt like that if they could diversify with this key percentage of bonds and equities, that somehow they would protect themselves. And that's not true. It's a fallacy. Bonds work like a teeter-totter. When the interest rate, the yield goes down, the value of the bonds go up. So we're in a situation now where the value of the bonds have gone down to zero. The yield has, and so the value of the bonds have gone up. And there are some well-managed bond funds that are taking advantage of this right now. Okay. This is a very busy chart. The red numbers are basically the intra-year declines versus the calendar year returns. So you can see that, like if you go to 1980, you had an intra-year loss of 17%, but overall you made 26 for the year. Now, when you're down 17%, I would have to suggest that emotionally, you're pretty nervous about the market and probably in a way a little confused about what to do. And so if you look across there, you'll see that the emotional aspect of what most people experience can be very confusing. Now, if we go out to about 2008, we see the market was down mid-year 49%, and it turned out to be down 38. Now, we just talked about 2008 before, but I thought we'd point it out to say, well, what was going on during that period of time? Okay, you've heard this before probably. You know, if you stay fully invested, you know, your rate of return will average out about 6.06. But if you miss the 10 best days, you're only going to get about 2.44. And if you miss the best 20 days, you're going to get 0.08. And if you miss the best 30 days, you lost almost 2%, and so forth. So if you miss the best 60 days, you're down 7%. And that's interesting. It's a plea, so to speak, to not time the market, to stay fully invested all the time and write it up and write it down. And I don't believe you can time the market for most people. A few folks can. I've met a few of them. But for the most part, you need to stay invested. But there's a method called tactical asset allocation that uses algorithms and a number of other technical functions to operate and to take out all the emotions and to really operate off of mathematics. And the idea behind tactical asset allocation is instead of missing the best days, you miss the worst. And with tactical asset allocation, you generally will get somewhere between 75 and 90% of the upside. But you'll also miss 75 to 95% of the downside, not 75 to 90% of the downside. Now, most people would like to think that they can have somebody really watching their funds day in, day out. And that person is going to make a choice, make a decision. So when the market starts to drop, what do people want? Well, most people want to be moved to cash. And so when the market gets ready to go back up again, they want somebody to move it back into the market. And so that's where we get this tactical. It's active versus passive investing. Passive is a buy and hold strategy. And for the most part, buy and hold doesn't work anymore, but the big brokerage houses use it. And they'll tell you now, when the market drops, you don't lose anything till you sell. Stay fully invested. Don't be getting out and going to do something else, you know, just hang in there. And the reality is that, in fact, I just had a client I talked to yesterday, and we have a thing for his 401k plan. He had part of it in the market just as a buy and hold strategy, passive investing, and the other portion we had in a tactical account. Now the passive account did about 8.9% in the last 90 days. So he did pretty well. Most people are happy with 8.9. But the passive account during that same period of time did almost 19%. Okay, so, and I told him, I said, you can't expect that all the time, but it definitely clearly showed the difference between a passive account and a tactically, actively managed account. Sure. We're going to try to play a little video. It's a short video here. We'll try it. What we'll do, especially if it doesn't work, we'll send it to you. Yeah, let's see. This is a little, it's about a minute and a half, and it talks about tactical versus passive, and it kind of gives you a mental picture.
Tactical versus passive investing. John, the passive money manager, is driving to work. He's taking his preferred route. It's the most direct and has the fewest turns. When suddenly, he sees brake lights. Everyone is slowing to a stop. John doesn't want to be late to the big important meeting at the office, but he knows of no other path. He sits back in his seat, anxious about being late for his meeting and hoping for the best. On the other side of town, Ted, the tactical money manager, is getting ready to leave for work. Before getting in his car, though, he checks his traffic navigation app and quickly realizes that his preferred route to work will take twice as long as the alternative route today. Ted doesn't hesitate for a second. He hops into his car and takes the alternative route for a stress-free morning. What's the difference between a passive money manager and a tactical money manager? A passive money manager knows only one way to make money. If that isn't working, you'll just have to wait anxiously and hope it starts working again. A tactical money manager knows there is more than one way to make money and is willing to change course to provide a stress-free ride.
Now, the Optimus is one of the advisory groups we use for actively managed money. And so if this is something you're interested in, we just need to know that so we can just see which fund and which money manager would work the best for you. Questions? I don't see any coming up in the chat room. We want you to, it's strange to be talking to the wall, so to speak. I've experienced that before, but I'm not even gonna go there. But we do send out weekly emails. We have quarterly news updates, and every 6 months we'll do a halftime market update report. So until next time, we want to wish blessings upon you. You and your family stay safe and healthy, and God's blessings. Take care. I love you all.